What's up, everyone? It's Caddy with Money Vesting. So in this video, I wanted to break down a report, a very nice research put together by Tom Lee from Fundstrat Global. And yes, they are one of the most bullish strategists and analysts out there. And this report pretty much goes over very, very specific thresholds and signals that Tom Lee is watching. And we're also going to play a very quick clip to listen in on his take on disinflation and also talking a little bit about the current macro environment with respect to interest rates and the Federal Reserve Chairman Jerome Powell and historical rate hike cycles, as we have seen over 15 rate hike cycles in the past, of which over 11 of those, actually we've seen 14 rate hike cycles, and of those over 11 have been data dependent and stocks have risen as the Federal Reserve has hiked interest rates, and only 3 other occasions the markets have dropped. The 2 were under Arthur Burns from 1970s to low 1980s. And then the 3rd and final was under Jerome Powell in 2022. So some very, very interesting stuff, reported on his feed that I wanted to go over. Hope you guys enjoy it and find it helpful. And he also goes over one specific signal about the market, which has a 100% win ratio, which I'm also going to break down. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel, and also the link to our Discord and Patreon is going to be down below if you're interested in joining us. And there is a 16% annual discount that will go away in about 3 to 4 days. So if you want to take advantage of that, now is the time. The second link down in the description below is available. So first and foremost, I do want to play that clip on CNBC, which I think is going to be very, very interesting, and it's going to give us a little bit more insight into what Tom Lee is really talking about when it comes to his thesis on the market, especially when it comes to the macroeconomics. So I'm going to play this video, play this clip. I'm going to pause. I'm going to share my thoughts. Sash literally came out just yesterday, so let me know your thoughts as well down in the comments. But I'm going to do an audio check, and we should be all set here.
Tom Lee said that the January rally borrowed from February. So you're still expecting a tough, few weeks here, months? What's your time frame?
Yeah, I think investors should expect some payback. I mean, we had one of the best ever Januaries, and if you look at the 7 years that mirrored what we just saw, it's going to be tough in the second half of February to early March. But it doesn't mean the full year. I think there's no thesis change. I think this year is still going to be a story about how inflation cooling makes the Fed data dependent, not data reactive. And that means volatility is expected to fall both for yields and for equity risk premia. And that's why stocks can rally.
So I'll just play devil's advocate on the inflation thing. If the market has been...
First of all, that's the chart right there, which we have also shared in our market updates. That's the higher low that you're seeing for the S&P 500. And this is, of course, as of the day when the markets were selling off quite aggressively. They were coming down to under 4,000, 39.75, around those levels. And one more thing that he's going to touch on later in this video is equity risk premiums. And, very interesting take. I want you guys to hear carefully. And I'm kind of curious to know what your thoughts are. And I'll kind of explain what he means by that as well.
So focused on inflation because the Fed has been so focused on inflation, and the Fed is not convinced that we've seen a sustainable decrease in the inflation rate. So why wouldn't the market sell off every time there's evidence that inflation is harder to squash?
I think that's kind of what happened in the last couple of weeks. Everyone saw January data a little hotter, and they think the Fed's going to jump on that. But prior to that, we have to keep in mind we had 3 good inflation prints. Powell invoked the word disinflation 13 times in his press conference. We get the minutes today, and if we see more comments than that in the meeting, I think it allays fears that the Fed...
But that's old news. Since then, we have seen evidence that it might not be so disinflationary.
But the economy doesn't pivot. So when people say if inflation's flaring up, that's assuming the economy hinges on like a matchstick. And, I think there were a lot of January seasonals affecting that. And at the end of the day, gasoline's already rolling over, and if natural gas is tanking, and Carl pointed out lithium's tanking, and housing continues to weaken. Both sides of the inflation story are, and that's over 60% of core.
So one thing that he mentioned is that the Federal Reserve Chairman Jerome Powell used the word disinflation 12 times in his speech. Doesn't matter. It literally does not matter what they actually use as the wording for their press conference, because the Federal Reserve is very data dependent, right? They are going to react to whatever data is coming out, and they can flip on a dime, right? If inflation falls like a rock, it continues to trend lower. they are going to literally just pause interest rate hikes and are going to potentially pivot to start cutting rates. If inflation flares up again and it starts to push higher, accelerate to the upside, they're once again going to switch the script and they are going to be more aggressive with interest rate hikes. So it really depends on where inflation goes, not what the Fed says, but where inflation goes. Now, coming over to where inflation goes, Tom Lee does make up a good point, right? Natural gas is falling, lithium prices are falling, shelter prices, which has been the key driver for overall inflation in the last few months. I mean, really, if it weren't for shelter prices, we would have by now seen a lot of deflation in the economy already. But instead, since shelter prices pretty much make up 33-34% of overall CPI, that's what's holding up the overall inflation number. And once, if and when, of course, very two keywords here, if and when we start to see shelter prices roll over and come down, kind of be more in sync with what's actually going on, which we have already seen in apartmentlisting.com, the National Median Rent Index. They've been falling for 3 to 4 consecutive months. If that starts being reflected in the actual CPI report, then there's a very high probability that we see inflation trend lower and be more aggressive on the downside.
Deflating.
And you've pointed out shelter obviously lags the most.
Yes.
And if that really does, say, react with a 12-month lag, then this summer is going to be, we all got disinflation without it. What's disinflation going to be like with it?
Yeah, that's right. Let's say that the 60% of core is either 0 or negative, including housing going negative. You can't even get 2% inflation with the other 40%. So, I mean, I think you might be printing 2% inflation starting in the summer.
You made the point that a tough Fed doesn't mean the stocks have to go down with every inflationary data point. You point back to Volcker or even Arthur Burns, I think. But, you know, a transition like the one that we're in the midst of, from the zero bound to wherever we're going to end up at a terminal rate, is there anything that is, you know, can you really make that connection to that period in the 70s?
Yeah, I mean, we just published a piece on this that if you look at the 14 rate cycles that lasted more than 12 months, 11 out of the 14 markets rallied into highs with the hikes. The two exceptions were during Burns, when he was higher in a hurry. But actually, once Volcker became Fed chair, believe it or not, hikes were associated with higher stock prices. And of course, in Greenspan, there were 5 cycles of his raising. 5 of 5 times markets marched higher to all-time highs. So unless Powell is invoking Burns, I think the stock market is going to appreciate data dependence. I know people talk about equity risk premia is at an all-time low, but that's because inflation risk premia is at an all-time high. That's what's embedded in interest rates. So if inflation risk falls, yields will fall and equity risk premium is actually going to jump.
So that's actually a really, really good point. And he kind of rounds that thing really well together, because we've talked about equity risk premium in our previous videos and how it's actually dropping, right? It's actually come down from like 5% down to now trading at like 1.5%, closer to 2%. And the fact that, you know, stocks are becoming less favorable or less incentivized to be invested in versus bonds is literally a product of high inflation getting priced into the bond market, right? Because the treasury yields are higher, equity risk premium is lower, because inflation is getting priced into the treasury yields. Of course, we're seeing equity risk premium being lower, right? In other words, what he's really saying is treasury yields are higher, right? The 10-year yield, the 20-year yield, because of inflation expectations, and that's causing the equity risk premium to come down because of, you know, treasury yields being higher. So that's kind of like what he's talking about. And another thing that he mentions is that there's been about 14 rate hike cycles in the last, several decades. There's been that have lasted over 12 months, and 14 out of those rate hike cycles, 11 the stocks have rallied to new highs, right? There's only been 3 exceptions, the 2 being from Arthur Burns. And for those of you who don't know, Arthur Burns was another federal chairman of the Federal Reserve from back in 1970 to 1978. He was followed by William Miller, and then William Miller was followed by Paul Volcker. Just gotta jog my memory there. But Arthur Burns pretty much had very, very easy monetary policy. Of course, there were other factors that contributed to higher inflation, as the Vietnam War. We had the Watergate scandal. We had energy crisis. We had a lot of different things that kind of affected higher inflation in the 1970s. But because of the easy money policies from Arthur Burns, inflation really skyrocketed. And as a result, they had to raise rates from about 4% from 1977 to a peak of 20% in the 1980s before, of course, Paul Volcker had to come and take office in 1979 and, of course, keep raising rates to combat inflation. But what he's really talking about towards the end there is unless Jerome Powell invokes Arthur Burns, the market, in his opinion at least, should be higher and could be potentially hitting a new all-time high despite all the rate hikes. So on one hand, he's building his bull case on the fact that inflation is coming down and we are seeing disinflation. And on the other hand, he's building his bull case that even if we don't see disinflation, even if the Federal Reserve continues to hike rates, there is a possibility that the markets continue to push higher despite the rate hikes. And this right here is another really interesting report that he shared on his feed. Talks about, as a follow-up, on the team, below are the 3 technical signals that all occurred on January 12th, 2023, so like about a month ago. And notice the 8 prior instances all confirm a new major advance after a major market low. So the probability for this to push higher, in other words, for the S&P 500 forward returns and for the next 12 months to be bullish, are 100%. So that's what he's underlined in this sort of report. The win ratio for this particular signal is about 100%, and every single time that we've seen that, from 1970s to 1982, 2012, 2019, 2020, every single time we've seen at least 2 out of the 3 signals get hit, the markets are higher double digits in 12 months to follow with that. And these are some of the Whaley breadth thrust. We've got the BAM thrust and the 7070 thrust. A lot of them are momentum signals, which pretty much go over advancing versus declining stocks in the New York Stock Exchange. And all 3 got hit on January 12th, 2023. And only instance of 3 of 3 since 1970s is what Tom Lee's also talking about in his report, and he's suggesting an average gain of 25.4% over the next 12 months. The markets have already pushed up. From January 12th, we might be up like a couple percentage points, but there's still a lot of potential upside left, according to Tom Lee. So let me know your thoughts on this. Quite interesting, that's for sure. And again, this right here is going to be the tightening cycles, and 11 out of the 14 data-dependent stocks rising to all-time highs during Greenspan. 5 out of 5 cycles saw higher stocks. Exceptions were Burns, so Arthur Burns from back in 1970s, and Powell in 2022. So quite an interesting analysis, quite an interesting take. This doesn't mean that stocks can pull back and see some mild drops here of 2 to 3%, come down to support levels, and then continue to rally higher. But very, very interesting take, and the fact that this signal has a 100% win ratio definitely goes to show that there might be some potential upside. Of course, sentiment is in the favor of the bulls already. We are seeing a lot of momentum to begin with. So really the big key question remains if inflation is going to come down or not. And the second big key question remains, what is the Federal Reserve going to do with interest rates? But Tom Lee's bullish thesis stands alone, despite the fact that even if interest rates keep rising, even if the Federal Reserve keeps raising interest rates, the market can sustain those levels and continue to push higher, unless, of course, Jerome Powell invokes Burns and starts to absolutely go crazy in raising interest rates quite aggressively much faster. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like, subscribe, and the link to our Discord and Patreon is going to be down below if you're interested in joining us. As always, happy investing, and I will see you all in the next video.